This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, September 27th, 2022. And I'm on, as always, with my partner, Dominick Tavella, after 2 weeks off. How are you, Dom?
Hey, Michael, how are you? Doing well. How about yourself?
Good, nice and rested and ready to go.
Yeah. I don't know about the rested part. We've had a lot of stress in the markets lately, but ready to go.
All right. Well, look, the market giveth and the market taketh away. And we had a somewhat optimistic summer with the cloud off in the horizon. Are we going to retest the lows? And lo and behold, September comes in and here we are. Not only are we retesting the lows, we have fallen through the lows. So I guess that's what you're referring to with a little stress that we've been dealing with.
Yeah. And look, Mike, you and I have been doing this for a very, very long time. And we know historically, this is the weakest part of the year. Historically, we get to that September 15th, October 15th, 30-day period. And I don't know if it's as a result of lack of noise, lack of earnings report, lack of economic data, but historically, this tends to be a very bumpy time for the markets. And gosh, this year is no different.
So, Dom, I guess that becomes a philosophical question then. Is it anecdotal? Is it self-fulfilling prophecy? Or if you look at the market right now, the way I see it, there's really a lot of things to be worried about.
I think it's kind of lighting the fuse and then kind of nature takes over. There is a lot of stuff to worry about. And there really is a reason why markets are behaving the way they are. And does seasonality make it worse, or it's the oh my gosh moment and kind of because everybody was looking over their shoulder and here it is? I don't know what comes first, the chicken or the egg, but clearly we are in an environment today where there is a lot to worry about. And we're going to get into whether it's justified or not, but the markets are very concerned at this point. There's some significant economic issues floating out there. And I think you and I both would agree, rightfully so. But the season calls for it to also be very soft.
So let's go over the numbers like we always do and look at the week prior. So the week prior, Dom, the S&P 500 gave back 4.63%. The Dow Jones gave back 4%, and the NASDAQ gave back 5%, which is a big number.
For the week.
Yeah, for the week. And this week hasn't started out any better. So the numbers are even worse.
And we can look at where we closed the markets on the end of August. And we had a pretty good rally, as you already alluded to, Mike. We had a pretty good rally in August and people started feeling better. And the major indices were plus or minus around negative 10% for the year. And people are like, oh, wow, things are getting better. But you and I, and we've talked about it on this very show, and we've talked about it with our own clients. No, we weren't fooled by that at all. We saw that as a bear market rally, maybe an opportunity to raise a little bit more cash. But since then, I think as of Friday, the S&P was down about 23%, and the NASDAQ now down 30% for the year. So those are significant losses, year-to-date numbers.
And I think the reason the market clawed back half of the losses they had is, and again, I don't know if it's a narrative that the financial industry was pushing or the financial media was pushing, but there was a narrative that the Fed was going to be accommodative as soon as they saw that inflation was cooling off. So two things have happened since then. Inflation still has not cooled off. It's been frustratingly high. And I think the Fed in their last meeting last week, in their notes on Wednesday, basically implied that they're digging in and they're going to not be necessarily accommodative.
Mike, I want to give you credit. I think you brought this up one of our earlier calls that if we look at these markets prior to some of these Fed meetings, the market rallied into those meetings thinking that the Fed was going to change its policy stance and not be quite as aggressive in tightening interest rates. And then, of course, they were disappointed. And this last one was no exception. We started hearing some noise out there. I love to call them the bobbleheads in a box in the financial media, that the Fed might even be lowering interest rates the early part of this year. How silly was that interpretation? And the Fed Chairman Powell came right out and just slammed the door, saying, hey, we have no intentions of easing. We have no intentions of slowing down, and we will be as aggressive as we need to be for as long as we need to be. And with that kind of stance, is it any surprise at all, Mike, that the markets turn right around and again retested and went through the June lows?
I mean, I know this is a silly analogy, but it's like Jerome Powell and the Fed, is the stock market's daddy. And he laid down the law, and the market threw a tantrum because they didn't get what they wanted. Because you're right, Dominic, you're 100% right. What the market wanted was at least a glimmer of hope that the Fed was going to be a little bit more lenient in going forward.
Completely correct, Mike. And we're going to get into this now in the second part of our discussion. But at the end of the day, it really comes down to, does the Fed, and I understand their interest here in slowing the economy down and trying to slow this inflationary scenario, but at what point do they over tighten and push this economy into not only a recession, but possibly a deep recession? When do they see the light that maybe they've done enough?
So we're going to get into that. We're going to get into the behavior in the Treasury market recently. We're going to get into whether we have a recession or a soft landing or a hard landing. We don't have a guest this evening, Dom. It's just going to be me and you going over these topics, and we will be right back to get into all of it and more right after this break.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella. And Dom, as I was preparing for the show today, taking some notes, one part of the market recently, which I don't think is getting a lot of attention, is for years, when we were in this low interest rate environment, stock market was pretty much the only game in town, right? The only place to really get a decent return on your money for a very, very long time. So yes, there'd be sell-offs, but we would see these quick rebounds like a rubber band, because at the end of the day, people, investors, our clients were not happy, earning literally,
Nothing.
a tenth of a point, right? Now, and I love your opinion on this, stock market's not the only game in town, Dom. I mean, right now, the 2-year Treasury is inverted. You could get 4.3% for 2 years guaranteed. You could go buy an annuity and get almost 4.5% for 5 years. You could buy a CD and get 3% for the next 9 months. So the stock market now has some competition, which I think also is leading to some of the softness and some of the volatility that we've been experiencing.
Yeah, Mike, spot on again. And so when we get clients like, oh, why is this happening to the stock market? We're probably going to cover a half a dozen reasons tonight about why the market is behaving the way it is. But that's probably one of the most important ones, is that, hey, I can go out there now and buy some really good quality interest bearing bonds, whether it's a treasury or a municipal bond, and feel comfortable that, okay, I'm not going to get rich, but I'm not going to get poor. And so monies that would normally go into the stock market and push stock prices and indexes higher now is leaving those sectors and depressing those prices. And where do they find a safe haven? They find it in fixed income and interest-bearing accounts. So for investors that have new money, this is a wonderful place to allocate some dollars. We've seen some incredible flows out of stock stock index mutual funds and ETFs and into the fixed income side of the investment world, we're always running balanced portfolios. For us, this is also a godsend, and for our clients. But it's, as you said, appropriately so, it's now competition for stocks, and therefore maybe not as much upward pressure on equity side of the investment world.
Let's be clear on something, Dom. You know, the corporate sector year to date is still down 17%, and the municipal sector is down 10. So when there's sectors of the fixed income that have done miserably this year. We've talked about it. We've talked about it on our podcast. But now with the treasury market having these attractive yields, you can make an investment backed by the United States government. Look, unless it's an apocalyptic event and the government can't pay their bills, you're not losing 17% on a treasury.
Well, this gets a little wonky, and I apologize, Mike, for making it such, but if you had bought a 10-year treasury on January 1st of this year,
You'd be down
because interest rates so low, you'd be down about 18% in the value of your principal. Now, 10 years from now, well, 10 years from January of this year, 10 years from now, you would have gotten your principal back,
right,
and you would have earned interest every year while you were waiting. But if you went and sold that bond today, you would get about 18% less. That's the bad news. If you're buying that bond today and you're starting the clock today, you're getting on a 10-year treasury, you're getting almost 5% on that bond, Mike? 4.
I don't think it's that quite high, but it's getting there.
4.7, 4.8%.
Yeah.
And so if you own the old bonds, you're not a happy camper, but if you have the opportunity to buy bonds today, it's a pretty wonderful opportunity. And I like to remind, at least our clients, we are sitting with a plus or minus 25%, more plus than minus cash. So that we have an amazing opportunity to buy, whether it's fixed income bonds or stocks at pretty discounted prices.
Yeah. And yeah, you said something also that's pretty important. If you hold on to that bond, you will get all your money back.
You'll be whole.
What the disadvantage is, if we're in a high interest rate environment for that whole time, the time value of money is not your friend either. But the key there is to hold on. But my point in bringing this up is what you just said. If you're getting the 10-year, if you're willing to tie money up just for 2 years, right now with the yield curve being inverted, and I'll ask you to explain to our clients what that means in plain English in a minute, you could literally get a yield of over 4% for 2 years, basically guaranteed, if you hold it to maturity.
And again, this is a relatively short maturity vehicle, and we're certainly not proposing that a client go and put 100% of their money in this kind of a vehicle, because you have to, and this is a question I ask my clients when the subject comes up: where do you think the market's going to be 2 years from now? I mean, we don't have a crystal ball, we can't predict it, but do you think we make up most or all of our losses within the next 2 years? And most of the time the clients say, yeah, I think we'll see a recovery within the next 2 years. Well, the S&P is down 23, 24%. So if it takes you 2 years to make that money back, that's at least a 12% return. If it takes you 3 years to make that money back, that's an 8% return. And I can take this math out such that, some of your money in a very safe place is not a terrible idea, but to take risk completely off the table, that in hindsight might be also a mistake.
I had a client ask me that very same question today. Well, if I could get 4% guaranteed, why don't all your clients do that? And I said, well, because they think that stock market's going to improve. I think the stock market's going to improve. And we think, over time, you should do better than that. So you're 100% right. But my point is, it's not just about me and you, right? It's about all these large institutions, Dom, these endowments, these pension funds, which really have to be super cautious. They're the ones who also are selling some of these maybe more volatile stock positions and buying these safer investments. And that's where the stock market, because as we both know, what is it? 80, 90% of the trading now is done by computers.
Look, Mike, and we talked to an institutional money manager this morning, and just like us, they're very prudent. They're very careful about where they allocate their money. And in being prudent and careful, that means you also have to look at opportunities in the stock market and say, hey, where do I think this, not only the market, but specific sectors of the market, where they're going to be a year from now and 3 years from now and 5 years from now. And a proper allocation at the end of the day gives you the best total return. So we have to be careful and go, we don't want to be too conservative, especially after the market has come down. And yet we're not going to speculate and bet the farm. That's not our place either. But looking at the markets and looking at the global economy, we're trying to make these decisions on a daily basis. And equities definitely still belong in a client portfolio.
Oh, it's interesting to hear you say that after the great bull market we had. And the truth is, I don't know, every 2 out of 10 years, we're going to have a bad market, and out of 8 out of 10 years, we're going to have a good market. So yeah, it does take patience, but also you do have to move the furniture around every now and again. And I think what we heard this morning from, I think it was BNY Mellon. Oh, I don't think, I know it was BNY Mellon who came on our morning call. What do you talk about, Dom? Healthcare, financials,
energy,
and energy were the 3 that they like at the moment.
Yeah, and you know, we don't want to get wonky again into the individual securities, but when something is sold off and selling at a discount, and in this case, it could be a 20-30% discount to where it was at the beginning of the year. I'm not saying this is the time to buy or the opportunity of a lifetime, but you're already starting with a cushion of 20+%. And the key, of course, is having the patience and the fortitude, right? The stomach churning volatility to just ride out the curve. And Mike, you and I have been in this business for over 30 years. How many corrections have we seen, Mike? How many of these have we gone through and we've held clients' hands through? And at least up until now, the markets ultimately do recover, and the clients do get whole. Up until now.
Yes, I mean, I think we both know that as kind of. Neither one of us can make predictions, obviously, but if history is our guide, we feel pretty good in guiding our clients in that direction. But when you get a market like this where no one wants to own anything, you look at a sector like financials, where we knew that interest rates were going up a year ago, and in the past, financials have done unbelievably well in a rising interest rate environment. We have the fastest interest rate environment in 40 years, literally. So why the financials stinking up the place like all the other sectors other than energy?
Yeah, great question, Mike. And energy, just let me cover that one for a second, has dropped 15% in the last 30 days. So you're going, wait a minute, what's going on here? And this is indicative of the entire market. There's a real fear now because of the posture of the Fed and how aggressive they're saying they're going to be going forward in raising interest rates, that the Fed pushes this economy into not only a recession, but potentially a deep recession. So think about unemployment going to, from what, 2-3% now, Mike, to 5 to 10%, and corporate profits going off the charts low, companies filing for bankruptcy. And all of a sudden you're talking about an economy that is negative, right? That's a recession, and profits going down and unemployment going higher, and people won't be driving to work. People will not be, companies won't be manufacturing. People won't be traveling for entertainment purposes. We'll see financials, banks having businesses go out of business, bankruptcies. We'll have individuals, because they lost their job, default on their credit cards and default on their mortgages, right? So we are really talking about financial Armageddon. And that instills a great deal of fear. So when you look at why is the market down 23-30% in the NASDAQ, it's this fear of a major recession coming down the pike.
And but I do think that the camp is split on that. The gentleman we spoke to today thought we can avoid that. We're going to be with JP Morgan on Thursday and hear some of their people and get what their views are. So you're right. There is a large group of people who feel that the Fed is overcorrecting.
Will overcorrect. The classic line today is they're going to make a mistake. And think about the one little stat, Mike. Today, for the first time, I heard a 30-year mortgage, 6%. That is literally double what it was on January of this year. So if you're looking to buy a house, you've just doubled the interest rate that you're paying on a mortgage. And that makes the affordability of that house way, way, way less. And so now what if real estate prices start coming down? And they've started to roll over, by the way, just a little bit. So you have, and I'll say half for the sake of this conversation, half of the probably really smart people on Wall Street going, this is going to be a major problem with a big, deep recession. And we have half of Wall Street going, wouldn't be so fast on that one. Recession possibly, but mild, and we'll come quickly out of it. And which camp you're in really drives what your portfolio looks like.
Yeah, and so to your point, I think your statement about mortgage rates requires context, because 6% interest rate is not outrageous.
No,
on a 30-year mortgage. I think it's probably close to the average.
We probably, and I know we have children that never heard of that number in terms of what mortgages, but you and I literally remember my first mortgage, I think in the early 80s, and it was 15%.
Exactly. So you take the mortgage rate being at 6, okay, it's high, but it's not outrageous on a historical basis. And then the other thing is, I'm old enough to remember when the stock market was doing well, right? Like 11 months ago.
Yes.
And what were people worried about, Dominic? An overheated real estate market, an unsustainable real estate market. So is it terrible that housing prices come down a little bit? It's not the worst thing in the world.
Look, Mike, and it's really easy to criticize the Fed. We know they made a policy mistake by waiting too long to raise interest rates.
Absolutely.
Now, I hate to say it, sorry, but the truth.
Mm-hmm.
Now they're being a little bit over aggressive in terms of their tightening policy to make up for what they should have done in 2021.
Mm-hmm.
But if we're going to be honest about the scenario we're in right now, we had a real estate market that was going up by 20% a year, where you had people lining up to overbid. And that was potentially a bubble that could really have ended ugly. We had investors in cryptocurrency that didn't even know what it was. And crypto has come back down from a pricing that I think is more reasonable. I'll let the experts decide on that. We had investors buying SPACs, that special acquisition purpose corporations, whatever the acronym stands for. I'll let you correct me, Mike, that didn't even know what that stuff was, but were choosing to throw money at it. And I can go on with another half a dozen of these aggressive speculative companies that, didn't even make money, yet they valuations were through the roof. All of this has deflated. And in my opinion, my humble opinion, has taken risk off of the table in somewhat of an orderly manner. So you got to give the Fed credit for that.
And so, Dom, again, I agree with you, but isn't that the purpose of raising interest rates in the first place? They tap on the brakes?
Yeah, they certainly didn't state that, but these are very smart people, Mike. And I have to believe in a closed room behind closed doors, they said, hey, there's a real danger of some of this speculation becoming systematic. That's the word they used back in the 90s, where it could do some significant damage to the economy. But if we are able to let the air out of the balloon slowly, yes, damage, and we can see where the markets are today. We've had a pretty significant bear market correction, but not systematic, and perhaps maybe not the deep recession that some of the experts are calling for.
I am in the camp that there probably will be a recession. I don't know if it's necessarily going to be, an apocalyptic recession. However, the things that we have to keep an eye on as it relates to that is when will the job market start to weaken? When will corporate earnings start to deteriorate? So I still think there are factors that you could hold on to that might prevent a recession, but if a bad recession, I'm sorry, but if they start to break down, then it could have a domino effect.
Yeah, you're exactly right, Mike. So on the employment side, let's remind people we had somewhere close to 11 million job openings. A lot of those job openings are disappearing. So it's not, that wouldn't necessarily affecting the unemployment number, but the fact that those jobs aren't open anymore affects the overall job market, right? But not the unemployment number. We are starting to see, especially in the more speculative corporate side of Wall Street, where some companies are laying off. But again, it's not ginormous, it's not systematic. So the unemployment number is slightly ticking up. But the one area that really worries me is the second point you made. I think that corporate earnings are still too high, and that shoe will drop. And that we're going to go into earnings season very shortly here. That number for the quarter may not be ugly, but by the time we get to January, I think, and again, so apology for getting wonky, Mike, but Wall Street is expecting earnings on the S&P in the $325, $330 range. That number may come down by 10%. And that might be the final shoe to drop for that last whoosh in the market before we can start building up off of it. So not terribly worried about the unemployment number, but am worried about will earnings hold up.
And earnings, to your point, I was reading a report from another financial institution, with market hitting these lows, the PE ratio in general, which is a price earnings ratio, which is a price of a stock times the multiple of their earnings, has still been relatively strong. And it's expected, Dom, I hate to tell you this, that kind of has to deteriorate for us to kind of form a more permanent bottom.
Yeah,
one of the factors.
It's the last shoe to drop, Mike.
Yeah.
Which I know for our viewers and listeners, that might be a scary prospect, but frankly, it would, from my perspective, would actually be terrific news, because and again, not getting wonky, this multiple adjusts with the relative risk that's in the market. So you want a more conservative multiple, a more conservative number when you're making your estimations on the value. And usually that happens at the bottom of the markets, right? Most of these analysts don't do it when the markets are high. They wait till, we see this big, ugly bear correction, and then they go, oh, we need to adjust the risk that we're assuming on the valuations. But usually by the time they get around to adjusting these valuation numbers, then it's time to start buying, So we're holding a lot of cash, and we're being really patient in our buying, but buying we will do.
Well, look, that's our job, right? Is to not, as you said earlier, not to be market timers, but sometimes these opportunities just kind of hit you in the head, and you have to take advantage of them when you get your bell rung like that. So look,
fear usually takes over, right, Mike? Where people don't want to do that. So fear takes over common sense.
Let's take a big break. And when we come back, let's talk about the three underlying factors that have really been the backstory for this whole year. And that's inflation, interest rates, and a possible recession. We talked about it a little bit, but let's try to tie them all together and why the market has been so nervous for most of the year. So we'll take a quick break and be right back after this.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella. And Dom, what I talked about when we went to break is the three things that have overhung on the market this year is inflation, interest rates, and recession. What's really interesting, in the beginning of the year, it was all about inflation because all you heard about was $5 gasoline and it was going to go to 8, which it never did. And that was all obviously a headline. And although food really hasn't gotten cheaper. I mean, I think, everyone feels when they go to the supermarket, the price of food has really gotten extremely expensive. The price of energy's come down significantly. So my question for you now, what are you more worried about? Are you more worried about inflation? Or are you more worried about interest rates?
So let's cover the inflation one, Mike. And yeah, as you know, as we've mentioned, I have quite a public viewership. I do interviews all the time. And so I want to go back to 2021 when the Fed was talking about inflation being transitory. And my comments back then were transitory did not mean 3 days, 3 weeks, 3 months, most likely 3 years. And that's, the analogy, is the python that swallows the pig, and it needs to go through the body till it comes out the other end. And so you have this big lump and eventually it comes down to zero. So 3 years is next year in our cycle. So I think we have this big lump amount of inflation that's kind of working its way through the pipeline. And eventually it will not disappear, but will go dramatically lower. And you've heard all the stats, Mike. Look at the price of lumber, look at the price of copper, look at the price of steel, look at the price of oil, look at shipping rates for product. I mean, I can go on and on and on. Price of homes and real estate. Everything has rolled over, even food, not as much as we would like to your point, but these costs have started to go lower. Lumber is actually at the price it was before this whole mess even started. So eventually this all goes through the pipeline. It comes out the other end. I think by next year, inflation will be significantly lower than it is today. And I think we've already started, not as fast as we would like, we've started the process of rolling over. And I think even by December this year, we'll see lower inflation, but significantly lower a year from now. So I feel good about the inflation story. That's one. Interest rates. That's the scary part of this conversation, Mike. That's where I don't know if I feel good about it, because if the Fed was following forward-looking data, they would see what we're seeing. Hey, the thing that made the problem is starting to roll over or has dramatically come lower. So inflation shouldn't be as high tomorrow as it is today. But if you're backwards looking, if you're driving a car in reverse, it's much more difficult to get it right. And there is the potential for a policy mistake.
So if we looked at either our podcasts or other media or old articles from the beginning of the summer, the Fed raised 75 basis points. The narrative was they had whatever it was, 6 weeks or 7 weeks to analyze what was going to happen. We had 2 more CPI, Consumer Price Index, data points come out, and they were stubbornly the same. They weren't higher. Well, I think one may have ticked up a little higher. The July one.
Yeah,
the August
and the
one,
latest one was a little bit lower, but stubbornly high.
Yeah, and it didn't come down. So now all of a sudden, the narrative or their hope was, well, maybe the Fed can maybe take a month off or only raise 25 basis points. So suddenly they're doing 3/4 of a point again, which is very aggressive, very aggressive. So like you said earlier, they have the same access to information we have. However, I do agree with you. I think the word transitory will be part of Jerome Powell's eulogy, whenever that happens, right? He's going to that's going to be a part of his tenure at the Fed forever. So do you think now, are you afraid now that he's overcompensating?
So one of our favorite, and he's been a guest on our show twice, Dr. Siegel from Wharton, I think just recently had a mind explosion.
He was angry. Yeah.
Yeah, and listen, let's be fair. He was on our show in 2021 and he predicted this. He literally wrote the script for this. And I guess what worries me a little bit is that he's writing the next script, and the next script is that the Fed, for whatever rationale, is going to miss the boat again and over tighten, that they shouldn't have even done the 75 basis points this last time. I'm willing to give them the benefit of the doubt for this last one, Mike, because maybe you want to make sure you put the nail in the coffin of inflation. But I think the next one and the next one have to be more subdued, maybe 50 basis points on the next rate hike. And then the one after that, maybe 25 basis points. And then January 1st, a pause. You got to, because let's be honest, it takes 6 to 12 months for this interest rate pipeline to get in the economy. So if you raise interest rates today, you cannot reasonably expect a reaction by the economy, not the markets, within 30 days. It takes 6 to 12 months for the economy. And we go back to our mortgage rate, Mike. If you're buying a mortgage rate today, not the entire country is refinancing and buying a house today. It's over the next 12 months. So the economic impact is 6 to 12 months out. I think they have to pause in January. They're not listening to me, by the way, or Dr. Siegel.
Well, I think they might pause in January, because I think what they've kind of telegraphed was 2 more interest rate hikes for the rest of the year, and then kind of we see where we are. But to your point, you mentioned refinancing. We talked about real estate, earlier in the show, but refinancing drying up is also, no longer stimulative to the economy. Because why do people refinance? To lower their interest rate, which inevitably they do one of two things with. They save it so they can spend money on other things, or actually save it, or they make a home improvement, right? So that's a part of the economy, Dom, to your point earlier, that is also going to hit the brakes.
Yeah, and that was your last point, Mike. We talked about inflation, we talked about interest rates, and the last comment you made was about recession. And our belief was always that, and we've been pretty consistent about this call all year long, that recession this year, highly unlikely, but starting with the first quarter into second quarter of next year, much more likely. And historically, the first quarter of a year is not typically great, and it wasn't great this year, but don't expect it to be positive next year. And then the second quarter, is kind of touchy. So I wouldn't be surprised if we have our real recession the first half of next year. But is it a mild recession? Is it an earnings recession where corporate profits drop by 10%, 15%? Or is it a real deep recession where unemployment goes from 5 to 10% and corporate profits really go through the floor? That's the worrisome part of our forecast right now. Next year, early part of next year is when we worry. We're really worried.
So let's spend a few minutes now and talk about, the practicality of how all of this affects our clients and investors in general. And Dominic, the buy and hold client is always going to be fine, right? Because they're not taking money out monthly. They're not living off of these investments, hopefully. So they're fine. They can wait it out. They're cool as a cucumber. They know past history tells them to do nothing. However, there's an awful lot of clients we have, Dom, that we send money to every single month. And one of my clients actually asked me to address this on the podcast. And she considers herself a smaller investor. and I don't know if it matters how large of an investor you are, but I think those clients who take monthly withdrawals from either ourselves or their bank account, they really have to look now as to, do they need all the money that they're taking? Are we better off sending them money every 6 months rather than monthly? So I think it's important to spend a few minutes. I'm talking about the folks who have money with us and invested in general, who make monthly withdrawals, and the decisions that we have to make with them and they have to make for themselves as it relates to their investments.
That's a great question, Mike. And so I know both you and I we try to be very reasonable when we're forecasting clients and how much they can take out and how much they can withdraw on a monthly or quarterly basis. We try to be very reasonable with those numbers, understanding that when the markets outperform like they did last year, that's not gravy that you get to go and spend anytime you want. That's meant to cushion the bad years like this year, right? So as long as the cash flow requirements are reasonable, I don't think you need to go and modify it. I'm going to start there. But, and I think this is probably one of your best points, if you're just going to take that cash flow and stick it in a bank account and do nothing with it, then leave it in the portfolio, because that gives us the cash to potentially put back to work at these discounted prices. So I'm a big believer in, if you need it, you need to pay your bills, you want to live your life, God bless, take it. You worked hard for it, you deserve it, take the cash flow. But if you don't need it, don't take it out of the portfolio. The second point I'd like to make is that in our case, Mike, again, you and me, we have the money already sitting in a money market account. We've been proactive about building up those reserves. So we're not in a place where we have to sell something that's fallen by 20% and sell it at a loss. We're able to take cash, liquid funds, money market funds, and give it to the client without beating up the portfolio. So that's an advantage that we have. We certainly have new clients where now they have to sell after the market's down 20, 30%. And that's not a good place to be. So we have the liquidity. But I agree with you wholeheartedly. If you need the money, God bless, take it. If you don't need the money or don't need all of it, leave what you can in the portfolio. Give us the opportunity to buy stuff at a discount and then hopefully get your assets back quicker.
Yeah, exactly. It's always about time horizon, and it's always about, the asset allocation. And let's not forget, if we get the asset allocation correct in the beginning, and we know a client's going to take money out systematically, we're going to typically put them in income and growth. Yeah, I talked to a client today. I have his money. I have his mom's money. Mom's 90, God bless her. I have her portfolio and income. And he said to me, we're going to still send mom money. I said, yeah. She said, but she's not spending all of it. I said, then let's send her less. And he's in growth and he's in his 50s. We're going to keep it exactly the way it is, because he doesn't need it now. But the point is, if it's that client, whether we have the money or not, if their withdrawal rate was exceedingly high, let's assume somewhere between 3 and 5 we could live with. But if their withdrawal rate is 6 or 7 or 8% when the year started, Dominic, and now they're down 20, now the withdrawal rate could be 9, 10, 11%.
Yeah. We have a new client that's coming on board and from another institution. And it's one of those cases, Mike, where they already started at an exceedingly high withdrawal rate because the value of the portfolio has come down as much as it has, in excess of 25%. Then that means that you're not withdrawing. At the time she started, it was 10% of the portfolio. Now you're withdrawing 15% of the portfolio.
10 was hard.
You're going to run out of money. It's written in stone. It's guaranteed. There's nothing you can do to prevent you running out of money. The only thing we can do is postpone the ultimate day by a little bit, but you cannot over withdraw. And we don't get too much of it in our case, Mike, with our clients. But especially in the good years, like, oh, we made a lot lot of money. I want to go buy the boat. And no, that's not how it works. You need the good years you harvest and you put the grain away in a silo and you save it for a rainy day. And in the bad years, you have what you've squirreled away to live off of, right? And I know it's biblical, but it's true. It's true. The reality is that you squirrel during the good years so you can have food to live on during the bad years.
So if it's, I was going to say if it's biblical, then it's true. Then is the Bible nonfiction? But that's a whole other show. It's way out of our
That's on the
wheelhouse.
next channel over, Mike. So.
Exactly. That's not what we're here to do. So we have 4 minutes to the close, and you and I always like to close on a positive note. So there's always positives to take out of any situation, right? We could always hopefully make lemonade out of lemons. So where are the opportunities? I know I'm putting you on the spot. We did not talk about this previously.
No, we don't. But I'm glad you asked me the question, Mike, because I do want to end this on a positive, right? So let's start with, we have another CPI number, October 13th, I think is the date. And there's a good remember the snake analogy? There's a good possibility that this number is lower, hopefully significantly lower, but lower than it was the prior month. Again, continuing this trend where inflation starts to show that it really is rolling over. And by the way, the Fed said they want to see months of this rollover. They're not going to accept one. So this would continue this process. That's one. Two, earnings season, we're going right into it. And I think earnings are not going to be great, but I think they're not going to be as terrible as some people expect, because the consumer is still spending, and we've seen that data.
I mean, travel's been ridiculous, right? I mean, people are traveling like crazy.
Just about, they're still going out to restaurants, they're still vacationing, they're still, driving is down, but I think earnings will be down, but maybe not as horrific as some people are talking about. We have an election, November. I'm not making a political call, Mike, I swear, but mixed governments historically have been very positive for markets, and we have never had a losing quarter in a midterm election, fourth quarter in a midterm election. So I'm not saying we're getting all our money back, but there's a strong possibility that if we stay true, we could have a positive fourth quarter, which would offset some of the losses. And one more. I think that if we continue to get good data through the end of this year, we could get a positive message. And we don't need it to be dramatically positive, just a positive message from the Fed that maybe they're starting to see the light at the end of the tunnel. That would make the market snap back dramatically. So 1, 2, 3, 4, 5, I'm not sure how much I got, but I think there's a good possibility here for maybe the year-end numbers not being anywhere near as horrific.
I think what you said earlier, Dom, and those are all great points. I think what you said earlier, that between September 15th and October 15th is normally miserable for the market. Whether it's based on fact or it's anecdotal, almost doesn't matter. If it's psychological, it's fine, because a lot of experts have been predicting a year-end rally. And, Dom, we're kind of running out of time.
Call it the Santa Claus rally.
Exactly. Right? So hopefully we do get that Santa Claus rally, because all the Halloween stuff is up already. So we'll be talking about Thanksgiving and Christmas before you know it, my friend.
Agreed. And think of whether it's Black Friday or Cyber Monday, being able to buy the stuff on sale is really, really important. And we have companies out there now where share prices are literally on sale. So if you can buy and you can be patient, the reward might not come for a year or two, but when you look back and go, wow, what an opportunity.
Dominic, we are out of time, my friend.
Amazing that it just went so fast again, Mike.
It is. It always is. It's always interesting. I appreciate our audience hopping on this evening, and we will be back with a new podcast next week. Have a good night, everybody.
Great evening, everybody.